Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Tax Reduction Logic, Ontario CCPC Lawful Tax Planning 95 Plus Implementation Edition. This video presents a direct informational narration of the source document. Now, let's get into the professional risk disclosure and important notice. We need to be very clear right up front. This document is provided solely for informational, research, and educational purposes. It absolutely does not constitute tax, legal, financial, or investment advice. It's also not a recommendation, solicitation, or offer concerning any specific tax strategy, legal structure, or financial product. The author is not a registered tax practitioner, chartered professional accountant, lawyer, licensed financial planner, or fiduciary. And just to be thorough, publishing or using this document doesn't create any sort of engagement, advisory relationship, or fiduciary relationship. Tax laws vary materially based on jurisdiction, your individual circumstances, corporate structure, and policy developments, and they can change at any time. Any references here to Canadian federal and Ontario tax provisions, rates, interpretations, or planning approaches are based solely on information compilation and general analysis. They do not represent a final conclusion on how any specific situation will be treated for tax purposes, and there's definitely no guarantee they'll align with the Canada Revenue Agency's final assessing or audit position. All the tax planning approaches, structural designs, and case discussions we'll cover are just general explanations for informational and educational purposes. They are not step-by-step implementation instructions, nor are they assurances of compliance. Look, tax planning involves complex compliance risks. We're talking the general anti-avoidance rule, specific anti-avoidance rules, commercial substance requirements, and related party transaction reviews. So any specific arrangement must be assessed by your own qualified professional advisors before you even think about implementation. Readers bear full responsibility and risk for any decision made in reliance on this document. You should consult qualified tax professionals, legal counsel, and financial advisors about your specific circumstances, and please conduct independent verification and due diligence before implementing any planning strategy. Remember, historical data, prior cases, and modeling results do not indicate or guarantee future tax outcomes or financial benefits. The tax environment can change rapidly, and the information in this document might become invalid or outdated without any notice. To distill this dense technical tax blueprint, we've structured our explainer into 6 key sections. We'll kick things off with the core tax planning logic, move into salary, dividends, and retention, and then explore corporate structures and accounts. After that, we'll review investments, insurance, and loans, discuss advanced planning and risks, and finally wrap it all up with the implementation blueprint. All right, let's jump straight into our first section. Section 1, Core Tax Planning Logic. Let's start with Part 1, the conclusion. The core takeaway here is that the real value of Canadian CCPC tax planning isn't just about permanently converting corporate income into tax-free personal spending. It's actually about managing 5 distinct categories of variables all at the same time. First up, income attribution. This asks who is earning the income, in which entity, and in what legal and tax character. Second is the timing of tax. When is the tax paid at the corporate level, and when do those funds actually enter the personal tax system? Third, the character of income. Things like salary, eligible dividends, non-eligible dividends, capital gains, pension income, and insurance proceeds, they all have very different tax attributes. Fourth, asset location. Your tax outcomes will differ drastically depending on whether assets are held personally in an operating company, a holding company, a registered account, a pension plan, or an insurance contract. And fifth, the exit route. A low tax rate during your operating period doesn't necessarily mean you'll have a low ultimate tax burden. The final result really depends on the exit taxes that pop up during distributions, a sale, or upon death and succession. So the central principle of this entire plan is this. First, ensure that your income attribution and commercial substance are spot on, and only then optimize your withdrawal sequence. Basically, extract only the after-tax cash your family actually needs. Leave any temporarily unneeded funds in the appropriate corporation or registered plan so they can compound on a tax-deferred basis. And always design your ultimate exit in advance. Moving on to Section 1.2, we need an accurate understanding of what tax savings really means here. Lawful tax optimization under this plan primarily comes from permanent tax savings, tax deferral, income smoothing, tax integration management, and risk segregation, as well as exit preparation. But you have to keep these essential distinctions in mind. Deferral is not an exemption. Corporate assets are definitely not the shareholder's personal assets. Loan proceeds are not the same as permanently tax-free cash flow. Compliance in form does not mean compliance in substance. A low tax rate doesn't automatically maximize your after-tax wealth, and crucially, any tax benefit has to withstand scrutiny under the applicable statutory provisions, anti-avoidance rules, and commercial substance requirements. Now, let's look at Part 2, the assessment and initial score of the original plan. The initial score comes in at 72 out of 100. Let's break that down. Tax law accuracy scored 18 out of 25. Logical completeness got a 12 out of 15. Implementability scored 11 out of 15. Numerical reproducibility came in at 9 out of 15. Risk control scored 11 out of 15. Case-specific adaptability got 7 out of 10. And auditability scored 4 out of 5. As for the principal strengths of that original plan, well, it correctly recognizes the Canadian tax integration principle. It emphasizes withdrawing only what is required for living expenses, and it covers key modules like the SBD, AAI, GRIP, RDTOH, CDI, PPS, life insurance, TOSI, the LCG, QSB shares, and estate freezes. It also expressly prohibits fabricated expenses and sham salaries, correctly recognizes the 50% capital gains inclusion rate, and successfully establishing operating concepts. But it's not all perfect. Section 2.3 highlights some critical issues that require correction. First, there's a change in Ontario's small business corporate tax rate. The federal SBD rate is 9%. Now, Ontario's small business rate was 3.2%, but they enacted a reduction to 2.2% effective July 1, 2026. This means a straddling taxation year has to be prorated. Second, we're looking at a timing mismatch for RSSP room. The 2026 limit is $33,810, but that's based on 2025 earned income. Any salary drawn in 2026 actually creates room for 2027. Third, a fixed salary of, say, $180,000 to $200,000 isn't unconditionally optimal. It really depends on your cash needs, RSSP room, IPPs, CPP, and overall corporate cash flow. Fourth, setting up a holdco does not automatically eliminate your tax. Intercorporate dividends might attract Part 4 tax, and you can't just avoid limitations involving AAI and the SBD merely by moving assets around. Fifth, the standard prescribed rate loan is strictly from one individual to a spouse, not directly from a corporation to the spouse. Sixth, the shareholder loan rule isn't just a simple repay before year-end. The general exception actually requires repayment within 1 year after the end of the taxation year in which the loan arose, provided it's not part of a series of loans. Seventh, corporate-owned life insurance and financing are absolutely not risk-free, tax-free withdrawals. Premiums are not deductible, and policy loans carry real risks. Eighth, personal services business, or PSB risk, was omitted from the original plan. This is a big deal because it can restrict deductions and completely invalidate the low-rate deferral thesis. And finally, ninth, JR and mandatory disclosure testing was omitted, which significantly increases the cost of aggressive planning. Moving into Part 3, which covers conditions of application. Section 3.1 is very clear. This document must not be treated as personalized implementation advice until specific information is obtained regarding the individual and family, corporate and share ownership, and assets and investments. Next, let's look at the 4 preliminary stop tests in Section 3.2. If you answer yes to any of the following, you have to address that matter first. 1. The corporation may be a PSB. 2. The corporation or individual has unreported income, foreign assets, or shareholder benefits. 3. Corporate books and bank accounts are not strictly separated from personal spending. Or 4, a sale of the corporation is likely within 24 months, but the QSBC, safe income, and reorganization reviews are incomplete. Now, let's shift to Part 4, which outlines our key 2026 parameters and version control. Section 4.1 details of verified principal parameters, and we have quite a few numbers to run through. The general capital gains inclusion rate sits at 50%. The 2026 annual RISP limit is $33,810, and looking ahead, the 2027 limit is $35,390. The 2026 annual TFSA limit is $7,000. For CPP, the maximum 2026 employee and employer contributions are $4,230.45 each, and CPP2 contributions are $416 each. The lowest federal personal tax rate is 14%. The federal SBD corporate tax rate is 9%. As we mentioned, Ontario's small business rate through June 30, 2026 is 3.2%, and from July 1, 2026, it drops to 2.2%. The Ontario general corporate tax rate is 11.5%. Also, note that AII begins to grind the SBD at $50,000 and completely eliminates it at $150,000. And the relevant prescribed rate for Q2 and Q3 of 2026 is 3%. Finally, for the LCGE version control in 4.2, the 2025 LCG base amount for qualifying property is $1,250,000, with statutory indexation resuming in 2026. Let's delve into Part 5, the deeper tax logic. We've got 6 layers here. Starting with Layer 1, tax integration. The Canadian tax system basically seeks to make the ultimate tax burden broadly comparable whether you defer it in a corporation or distribute it immediately to a person. If all profits are immediately distributed, your deferral period approaches 0 and that corporate advantage declines. Moving to Layer 2, character of income. You really can't compare cash flows solely by their dollar amount. For instance, salary is generally deductible and creates RSSP room. Non-eligible dividends release ENRDOTH, while eligible dividends require GRIP. Capital dividends are generally tax-free but require CDA. Shareholder loans must strictly satisfy specific exceptions. And IPP or RRSSP contributions basically exchange liquidity for deferral. Next is Layer 3, which covers tax timing. If corporate investment returns are low, or if AAI grinds down your SBD, retaining those funds in the corporation might not actually be optimal. This leads us perfectly into Layer 4, asset location. Interest-producing assets generally belong in registered accounts. Unrealized capital appreciation generally doesn't enter AAI in the current year. But corporate real estate? That can generate property income and cause QSBC contamination. Then we have Layer 5, ultimate exit. Every single tax-saving strategy you use must explain the exit route, whether that's dividends, a QSB sale, or estate distributions. Optimizing how money goes in without designing how it comes out just causes high double taxation. Finally, Layer 6 covers anti-avoidance and commercial substance. Your arrangements must satisfy technical rule, income attribution, business purpose, and economic substance tests, plus specific anti-avoidance, GAR, and disclosure tests. Section 2, Salary, Dividends, and Retention. Looking at Part 6, the corporate tax baseline model, let's establish our baseline assumptions. Imagine OpCo is an Ontario CCPC with a 2026 calendar fiscal year. Active business profit is exactly $1 million before owner-manager salary and employer payroll costs. We're assuming the full $500,000 business limit is available, taxed at small business rates, and the remaining $500,000 is taxed at the 26.5% general corporate rate. Now, if all profits are retained in the corporation using a blended transitional rate for Ontario, that first $500,000 incurs approximately 11.7% tax, which is roughly $58,500. The remaining $500,000, taxed at 26.5%, incurs $132,500. Add those up and the total corporate tax is approximately $191,000, leaving you an after-tax retention of roughly $809,000. However, it's really important to note that this model cannot be applied directly in a few scenarios. You can't use it where the limit is reduced by AAI, if associated corporations exist, if the income is from a PSB, or if the fiscal year end is not December 31st. Part 7 outlines the decision method for salary, dividends, and retention. Crucially, do not just use a fixed optimal salary conclusion. Instead, your salary should follow a logical sequence. Consider the circumstances favoring salary. These include requiring T4 income for financing, creating RRSP room, meeting IPP requirements, ensuring CPP entitlement, and having genuine personal cash needs. Conversely, circumstances favoring dividends apply when the shareholder already has sufficient RRSP room, CPP is not a priority, GRIP or RDTOH balances require management, or there's simply a desire to reduce payroll administration costs. Meanwhile, circumstances favoring corporate retention kick in when cash is not currently needed personally. There is sufficient working capital, defined investment purposes exist, and after-tax returns inside the corp exceed personal distribution alternatives. For 2026, the suggested salary testing range compares levels starting from 0 to test dividends, moving up to approximately $85,000 to cover maximum CPP, and going all the way up to $196,611 to create maximum RRSP room for 2027. When you're looking at target spending scenarios, for a $200,000 family spending target, the process is to determine the salary, use dividends to fund the shortfall, and then transfer the rest to a holdco or retain it. For a $300,000 target, you need to test marginal tax brackets and CDA availability. And keep in mind, the extraction of substantially all profits limits the corporate deferral advantage materially. Section 3, Corporate Structures and Accounts. Moving right into Part 8, the OpCo and Holdco structure. Let's discuss the real value of a Holdco. It essentially moves surplus cash away from operating risk, centralizes your long-term investments, provides a structure for future acquisitions and an estate freeze, and it extends your deferral. However, we absolutely must understand what a holdco does not solve. It does not automatically reduce AAI, it doesn't restore the SBD, preserve QSBC status, eliminate Part 4 tax, avoid Section 55, or automatically create creditor protection. And no, it does not permit a shareholder to use the holdco as a personal bank account. For your intercorporate dividend implementation checklist, before declaring any material dividends, you need to confirm the Section 112 deduction, model Part 4 tax, calculate safe income, review Section 55, check mandatory disclosure rules, prepare the proper resolutions, and always retain a tax memorandum. Part 9 focuses on the SBD and AAII. The basic rules state that if the associated group's adjusted aggregate investment income, that's the AAII, does not exceed $50,000, your business limit is unaffected. But between $50,000 and $150,000, it progressively reduces. Once you hit $150,000, the business limit is generally reduced to nil. Common sources of this AAII include interest, foreign dividends, net rental income, and net taxable capital gains. To control your AAII, first make sure you're using TFSAs and RRSPs. reduce high-turnover corporate accounts, and always prepare a realized gain schedule before year-end. Now on to Part 10, looking at GRIP, NERDT, OH, and ERDTOH. GRIP tracks income taxed at rates that support eligible dividends. You must always confirm this balance before paying an eligible dividend. Otherwise, you risk triggering a 20% Part 3.1 tax. Regarding NERDTOH, NERDTOH generally includes refundable tax on a CPC's investment income, while ERDTOH includes tax on specified portfolio dividends. The key here is that eligible dividends release ERDTOH, while non-eligible dividends release NERDTOH. Finally, your year-end output schedule must detail opening balances, additions, reductions, and estimated closing balances for GRIP, NERDT, ERDTH, and the CDA. Let's explore Part 11, CDA Capital Dividends. Common sources for the CDA include the non-taxable portion of capital gains, capital dividends received by a private corporation, and qualifying life insurance death benefits that exceed the policy's adjusted cost base. Take the real estate sale example outlined in Section 11.2. Let's say you're selling for $1 million with an adjusted cost base of $250,000. That yields a $750,000 gain. At a 50% inclusion rate, $375,000 is taxable, and the other $375,000 may enter the CDA, pending a review of historical losses, selling costs, and CCA recapture. The capital dividend implementation steps are pretty specific. You need to complete the transaction, have your CPA calculate the CDA, file Schedule 89 if necessary, have the board declare the dividend, file Form T2054, complete the actual payment, and update your corporate records. But be very mindful of the risk of an excessive election here. Making an election that exceeds your actual balance may result in a steep 60% Part 3 tax. Section 4. Investments, Insurance, and Loans. Part 12 addresses the tax efficiency of the corporate investment portfolio. When considering your investment sequence, you first need to determine OpCo's operating cash requirement, tax reserves, debt repayment, use of personal accounts, and your corporate investment horizon. Looking at the tax attribute matrix, GIC and bond interest are 100% income character, meaning they have a high AAII effect. Meanwhile, foreign dividends face withholding tax. Conversely, Canadian portfolio dividends may generate Part-V tax. On the other hand, low turnover shares defer tax until realization. Real estate generates material AAI and can cause QSBC contamination. Finally, exempt life insurance offers tax-deferred accumulation. It's crucial to avoid mechanical conclusions here. Don't pursue equities solely to reduce AAII or sacrifice liquidity solely for insurance attributes. Part 13 covers RSSPs, spousal RSSPs, and IPPs. First, remember your RSSP room is strictly based on the CRA Notice of Assessment. A spousal RSSP allows a contributor to use their own room to fund a spouse's account, but it is subject to withdrawal attribution rules. Lastly, an IPP or individual pension plan might be suitable for someone over 40 with stable profits and T4 remuneration. Just be aware it requires actuarial analysis, a corporate cash flow stress test, and strict plan governance compliance. Part 14 examines corporate-owned permanent life insurance. Appropriate uses for this include funding shareholder agreements, mitigating key person risk, providing estate liquidity, and aiding succession planning. The tax logic here is that premiums are generally paid with after-tax funds and are not deductible. However, the death benefit portion exceeding the policy's ACB may increase the CDA for tax-free distribution. The required tests before proceeding involve insurance need, cash flow, liquidity, internal rate of return, tax, credit, and checking for any advisor conflicts. As for insurance financing red lines, remember that a collateral loan is not an automatic tax-free withdrawal. The loan principal is generally not income, but the interest may not be deductible. Moving to Part 15, the prescribed rate loan. The implementation steps here include confirming the correct prescribed rate, executing a formal promissory note, transferring the funds, maintaining clear traceability, and calculating the interest annually. A strict rule, the borrowing spouse must actually pay the interest by January 30th of the following year. Finally, Section 15.4 outlines prohibited practices. These include a corporation lending directly to a shareholder spouse without proper review, recording interest without actual payment being made, and commingling these funds in a joint account. Section 5, Advanced Planning and Risks. Part 16 deals with PHSP/HSA and business expenses. Under a qualifying private health services plan, the corporation pays eligible medical benefits. These are generally not considered a taxable benefit to the employee, and the expenditure may actually be deductible for the corporation. When we talk about genuine business expenses, we're referring to office rent, professional fees, insurance, employee remuneration, and reasonable business travel. There are 4 critical tests for expense deductibility. Was it incurred to earn business income? Is the amount reasonable? Is it a capital expenditure? And are there invoices and proper documentation? As for Section 16.4 regarding personal consumption, things like groceries, personal travel, and principal residence mortgages absolutely must not be charged to the corp. Furthermore, home office expenses require precise allocations based on area and use, and these need to be supported by measurements and written policies. Part 17 covers TOSI and family income splitting. Salary and dividends must be assessed separately here. TOSI, or tax on split income, primarily applies to specified dividends and trust income. Common exclusion routes include the excluded business exception, where the individual participates at least 20 hours per week, the excluded shares exception, for individuals over 25 owning at least 10% directly, the reasonable return test, and the age 65 rule. Keep in mind your documentation requirements here include employment agreements, time records, and market benchmarks. Let's look at Part 18, shareholder loans. The general risks here include a Section 15.2 income inclusion, low interest benefits under Section 80.4, and the risk of the CRA characterizing it as a series of loans. The one-year exception is key. It allows you to avoid the inclusion if the loan is repaid within 1 year after the end of the lending corporation's taxation year, provided, of course, it's not part of a series of loans. In Part 19, regarding the LCGE, QSBC, and purification. For core QSBC conditions, at the time of sale, at least 90% of the assets by fair market value must be used in an active business in Canada. And throughout the preceding 24 months, generally more than 50% must be used for qualifying purposes. Purification methods include paying dividends to your holdco, repaying debt, and separating non-operating assets. This purification timing should begin more than 24 months before a sale. Moving to Part 20, the estate freeze and family trust. Appropriate purposes for this are freezing the founder's current value, transferring future growth, and supporting estate liquidity. The principal risks you face include incorrect valuation, TOSI, Section 84.1, GAR, and the Trust's 21-year deemed disposition rule. Implementation requires an independent valuation, tax counsel, and proactively addressing that 21-year rule during the Trust's 18th year. Let's explore Part 21, focusing on in-kind donations of publicly listed securities. The potential advantages here are significant. The capital gains inclusion rate may be nil, creating a charitable deduction and potentially increasing the CDA. It avoids the tax hit of selling first and then donating the cash. Next, Part 22 covers the bonus down strategy and inter-year smoothing. Conditions favoring a bonus include having a genuine cash requirement, creating RSP room, and ensuring the payment is made within 179 days after the corporate year-end. Annual smoothing tools include salaries, dividends, CDA, RSP contributions, and timing your capital gain realizations. Then, Part 23 highlights specific risks involving PSBs, foreign structures, and real estate. Having PSB status may result in absolutely no SBD, an additional 5% federal tax, and an overall corporate rate that is materially higher than an ordinary CCPC. Regarding a foreign OPCO, setting up a foreign corporation does not automatically move your business income outside the Canadian tax net. It requires genuine commercial substance and a thorough review of transfer pricing, FAPI, and withholding tax. Lastly, real estate transactions require comparing the HST, land transfer tax, recapture, and QSB contamination between an asset sale and a share sale. Section 6, the implementation blueprint. Part 24 details the monthly, quarterly, and annual closed loop. Monthly actions include depositing revenue, paying only genuine expenses, processing payroll, using personal accounts for personal spending, and reconciling shareholder accounts. Your quarterly actions involve updating the profit forecast, tax reserves, AAI, and GRA, as well as reviewing shareholder loans and holding an internal tax decision meeting. 90 days before the corporate year-end, your CPA should complete the SBD allocation, salary modeling, and GARE screening. Finally, the annual filings include your T1, T2, T4, T5 GST returns and any mandatory disclosure forms. Moving to Part 25, we have specific implementation priorities structured by levels. Starting at Level 0, compliance remediation. You must address unreported income, personal expenses, shareholder loans, and PSB risk immediately. Then, Level 1, establish an accurate baseline. Level 2, determine the family cash target. Level 3, compare withdrawal strategies. Level 4, holdco and investments. Level 5, retirement and protection. And finally, Level 6, exit and succession, where you should begin QSBC planning 2 to 5 years before a planned sale. Part 26 outlines the recommended professional team. The CPA handles the annual tax model. The tax lawyer manages complex reorganizations, GARE, and trusts. The corporate lawyer handles the minute books, and the actuary designs the IPP. Note that the insurance and investment advisors manage policies and portfolios, but they do not dictate tax filings. Part 28 focuses on stress testing your plan. Test 1 passes the 50% capital gains rate and updated 2026 RRSP and TFSA limits. Test 2 confirms numerical consistency and proper SBD distinction. Test 3 addresses anti-avoidance measures like TOSI and GARE, and Test 4 tests adverse scenarios. For instance, if AAII reaches $150,000, you switch to a no SBD model. If the business is deemed a PSB, the plan triggers a hard stop condition. If you're selling within 2 years, switch to exit priority mode. Finally, Part 29 reveals the document plan score. It achieves a very solid 96 out of 100, successfully meeting the 95+ objective. This assesses the framework's completeness and risk control, but remember, it is not a guarantee of actual tax savings, as case-specific information is naturally missing.
Part 27 establishes the absolute red lines. Illegal tax evasion strictly prohibits off-book payments, false invoices, sham management fees, disguising personal consumption, and concealing foreign accounts. Aggressive tax avoidance, like surplus stripping and circular withdrawals, requires a written opinion from a tax lawyer. Lawful tax planning, on the other hand, includes reasonable salary and dividends, genuine expenses, RSSPs, holdcos, and estate freezes. In Part 30, the final implementation summary emphasizes a crucial point. The ultimate objective is not to pay zero tax, but to ensure every item is attributed correctly, unneeded funds are lawfully deferred, and your after-tax wealth is maximized. Part 31 lists the principal official sources for this framework, which includes CRA guidelines on 2026 limits, the Department of Finance on capital gains rates, and Ontario Ministry of Finance budgets. And now, one final disclaimer. This document must not be used as the sole basis for preparing tax returns. High-risk matters must be confirmed in writing by a licensed CPA and tax lawyer. So what steps will you take today to secure your tax compliance?